The first advance estimates from the country's premier statistics body, the National Statistics Organization, is flashing for you on the screen. It is a very big number compared to the poll we had. It's coming in at 7.3%. That's the first advance estimates for the current year. Remember, when the Reserve Bank first started estimating the current year's GDP, it had said 6.5, and a lot of people in the market thought that that was an ambitious number. Reserve Bank in its last policy upped the forecast for the current year to 7%, and now the country's premier statistics body is calculating the advance estimate at 7.3%. So that, I would guess, is the strongest number on the street. The next big estimate we have is from SBI. Soumya Kanti Ghosh looks at the GDP, estimates the GDP number at 7.2, the Reserve Bank at 7, and the CNBC-TV18 poll average of about 10 economists was 6.8%. So clearly, this number is an outlier, much higher than what the street was expecting. We also have the Informist poll that was 6.7, ours was 6.8, but the premier statistics body sees the number at 7.3. As I said, the nominal GDP number, however, is estimated at 8.9, exactly in line with what the CNBC-TV18 forecast was. I'll quickly run through the other estimates. Construction is expected to come at 10.7. Our poll number also was very close to 10. Manufacturing sector at 6.5%. Mining 8.1, that's a big one. Farm sector is only 1.8. Our poll was 2%, and I thought that was poor. But the NSO's estimate is also 1.8. GVA growth is expected at 6.9. And GDP, as I told you, 7.3 real and 8.9 nominal. With those preliminary estimates, let me invite our eminent panel. Joining me now is someone who has guessed it very close to the NSO, Soumya Kanti Ghosh, the Group Chief Economic Advisor for State Bank of India. Also with us, Shubhada Rao, the founder of QuantEco Research. And in a bit, we will be joined, I think, by Dr. Pronab Sen as well. Soumya, bingo. That's a bullseye number from you. You're the only one with a 7+ number in our poll. But what do you make of the other estimates? Construction 10.7, manufacturing 6.5. More generally, services at 7.7 and industry 7.9. Are the estimates in line with yours?
Yes. Thank you, Lata. I think first, just let me make an observation is that I think there is a new trend now that the CSO estimates are higher than RBI estimates. Earlier, what used to happen was that the RBI estimate was higher than the CSO. But for the last 2 years, it has been higher by 20 basis points last year, and this year it is already 30 basis points higher. It could go even higher. So that's the first observation. Basically, the games have changed. The second thing is that basically, if you look into the overall number, headline number, we just calculated the number for the second half also. I think agricultural sector growth rate for the second half is expected to fall to around 1.4%. So that makes the full year growth rate around 1.8%. So that's a tad disappointing. But in terms of the industry, the second half growth rate is 6.7, which is against 9.3 first half. The service sector is actually holding up. It is at 7.5 against 8% in the first half. And total GVA, total GDP actually growth in the second half is at 7%. So basically the 7% maybe have become the new normal if you look into the data for the last 3 years. But what is more important is that if you look into the core GVA, a proxy for the underlying activity in the private sector, that has moderated in the second half to 7.1% from 8.5% in the last year. And so basically the data actually shows that the numbers are more or less in line with what we are expecting, because we are actually expecting that the numbers could go higher, and that has happened. But another important thing, which I think this is also estimates which we are trying to make out right now, I think because of this nominal GDP number, the government actually will now have elbow room to spend more without showing a commensurate increase in fiscal deficit. So that number could lie anywhere between 35,000 crore to 40,000 crore. So overall, the headline number is impressive at 7.3%. The second half growth rate remains at 7%, so that doesn't go below 7. And the third important thing, that the government gets the elbow to spend more, possibly spend more without showing a commensurate increase in fiscal deficit. So all in all, I think there is reasons to celebrate regarding the numbers.
No, 1 minute. How are you saying that the government gets ability to spend more? Their GDP number, nominal GDP number, is 296 lakh crore. I distinctly remember the budget had said that they are expecting 301 point something, almost 302 lakh crore. So, if anything, on the margin, the fiscal deficit will have to be trimmed a bit, isn't it, Soumya? How can you say they can increase the fiscal deficit?
No, what I'm saying is they're not going to increase the fiscal deficit. The fiscal deficit, they will have a leeway to continue to have the fiscal deficit at the same level without showing a commensurate increase because of the nominal GDP number. That's what I'm trying to say.
Fair enough.
5.9%, they get more leeway to spend without an increase.
Okay. Without any increase in the fiscal deficit, I don't see how they get more. Whatever, 16.6 lakh crore, the fiscal deficit will have to be around that number, I thought. But let me clarify another doubt if Dr. Pranab Sen is with us. Good evening, sir, and thank you very much. Dr. Sen, how is this estimate done? Since you have been there, done that as the chief statistician, the CSO has about 7-8 months of data, right? And they are projecting. Now, we all know that the second quarter was an extraordinarily good quarter. We got 7.6 when, the polls and the RBI were expecting a sub-7 number. So, do you think that this extrapolation may be belied? After all, there is evidence of rural demand not really picking up in the third quarter, especially in the last month, December. Likewise, urban is showing a little bit of flagging. So, is the CSO just an arithmetic extrapolation of the 8 months? Therefore, is it a likely overestimation?
No, it is pretty much an arithmetic extrapolation. So what they do is that they essentially go by the seasonality trends that have shown up in the past and use whatever data they have, which, as you said, it's about 8 months of data, to do the forwardcasting.
There was an RBI member who raised this doubt some time back, around the time when they raised their estimate. He said that it's possible that the CSO will give a strong number because the first 8 months have been strong, but that may not happen. Our 7 may be more correct than their higher number.
That may well be the case. But, the fact of the matter is that as far as rural demand is concerned, it wasn't doing particularly well in the first half of the year either.
Okay.
I don't think that changes anything very dramatically.
Samiran Chakravarti wrote a note today, Samiran from Citibank, saying that rural is stabilizing at a lower level than he expected. And also, I think the paper noted some signs of urban demand flagging. So I'm just wondering if, the 9th, 10th, 11th, 12th month are not as strong as the first 8 months. Is the NSO number likely to be an overstatement? That possibility exists, you think?
It certainly exists.
Okay. So coming back to you in a minute, Shubhada Rao, I read out all the numbers to you. If you want, I could do it again. Agriculture 1.8, mining 8.1, manufacturing 6.5, electricity 8.3, construction 10.7, trade, hotels, transport, that's the weak one, 6.3. Finance 8.9 and public ad, defense and other services 7.7. First thoughts, Shubhada?
I think it's definitely 50 bips higher than what we were estimating at 6.8% as an advance estimate. Very clearly, I do concur with Dr. Sen that due to the extrapolation basis first 8 months, we do expect some sobering down of these 7.3 numbers to somewhere close to 7 is what my estimate would be. As far as the breakup is concerned, pretty much in line with agriculture, construction, and also some of the services items or elements like trade hotels. We were actually spot on as far as trade hotels was concerned. Finance was, of course, much higher than what we anticipated, but broadly in line with what was being earlier discussed. I would think that the first 8 months have seen a very significant ramp up in the growth momentum, which which, if you look at the high frequency data coming from November, December onwards, shows some fatigue in growth across board. And that is the reason why I believe that perhaps in the final estimates, we could see a growth for FY24 coming close to 7% and not as reported today at 7.3%.
Okay. Madhavi Arora of Emkay is also joining us. Madhavi, I'm a little taken aback by the private final consumption expenditure. The NSO is estimating it at only 4.4%. Now, is that a cause for bother, a cause for worry?
See, any which way, if you look at the consumption pattern, it has been very patchy, right? The rural consumption has essentially been sort of, non-performer to a large extent if I really smoothen the data. And even the festive season, if I adjust it for seasonality, hasn't been very strong either. So, there's been still a very patchy urban versus rural story. And within urban also now you're seeing the division of the premium class versus the middle income strata. So I think to some extent the private sector consumption story hasn't been too robust. I think the first half has still been very good, partly on account of the fact that, we saw, leverage consumption, which was led by relatively easier financial conditions to some extent. And possibly the second half of the year would see a relatively tighter lending standards by the financial sector. So that would curtail a bit of a formal consumption pattern that, we saw booming in the first half of the year. But also, I think the, uneven consumption story has been, there since COVID. We've seen it overall improve from what we saw post-COVID. But still the kind of division in terms of how urban versus labor, and within urban, how the premium urban versus the mid-income urban is now behaving is getting a little more visible.
Okay. Let me come to others also on the same point. Soumya, is that a spot of bother? That when you look at GDP from the demand side, then consumption is found wanting. How long will people do capex unless consumption really picks up?
Just allow me to make one small correction. I think I said the government can increase. I think the government has to curtail the deficit because the nominal GDP is lower. So that's one small correction which I want to make before. Specifically, 37,000 crore will have to be the expenditure compression if the fiscal deficit is kept at the same level. So just that one small clarification. And now regarding the second thing, regarding the consumption, I think the story of consumption, if you look into it, if you look into the year-on-year growth rates, and if I look into the second quarter growth rates in terms of the investment looks solid enough. But consumption, I think what is currently happening is that if you look into a sequential basis, quarter on quarter, there has been some improvement. But if you actually look over the yearly data, there has been a slowdown. So my point over here is that while the consumption may be impacted to the extent that it is not at 7.5% for FY23 or 11% over there. So my point is that it is actually mean reverting. And from that point of view, it will be better to look through the numbers in terms of a sequential growth rate, because that will give you a better approximation of where we are today instead of the previous quarter. So while the point on this is well taken, my sense is that we may not be doing as badly as we thought of.
Nikhil Gupta of Motilal Oswal, in his book, The 8% Economy, argues that we perhaps must have higher capex than consumption for a period, so that we improve productivity and capacity, and then consumption should take off. Is that where the country is heading? Therefore, can this be a positive trend? I will come back with that question after a very short break. Back in a jiffy.